All right, so let me tell you this quick story. So I met Lisa because I had this deal. And at first he came to me, he's like, look, I just want to get into a property. I'm a first-time investor, and I'm looking to get into the real estate space. And I have a property in Cleveland, Ohio. It's like $80,000. And it's a dupe. I think this one
Yes.
was a triplex. Like we first
Yes.
started with a triplex. And
Yep. Yep.
I was like, okay, okay. So I actually first went to this other lender that I was like, okay, we can get this done in 14 days, no
Yeah.
big deal, da 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 da. And then something happened where the deal fell out from underneath him, right? It
Yeah.
wasn't lender, it wasn't him, it
Yeah.
was something that was going on with the house. So then he comes to me, he says, hey, can you find me another lender? I have now a quad that I want to look at, da 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 da. And I said, okay, great, great, great. So I found another lender. See, the problem is right with this particular situation was it's under 100,000, right?
Yes.
So a lot of
Yes.
lenders don't want to deal with
Won't even
that.
touch it. Yep.
Won't
Yep.
even touch it. So
Yep.
it's like
Yep.
it cuts like by I have like 200 lenders and it like cuts it
Yes.
like by like three-fourths. So now I got
Yes. Yeah.
15. And then
Yes.
they're like, okay, wait, he doesn't have a primary residence. And I'm like, oh my gosh, no,
Yes.
he does not have. Okay, so now it cuts it even
That's
more.
it
So
all
then
with. Yeah.
I know, right? So I found the lender, and when we were going through the deal, when we were going through the deal, it was she wanted to charge a 15% origination fee. And he was like mind blown. And I'm like, oh my gosh, that's like no way. So I went back to my lender,
Yes.
my lender portal, and I went ham. I emailed probably 70 lenders and I put, this is what's going on. It's
Yep.
first time investor, under
Yes.
100,000. I made this
Yep.
close yesterday. And you answered the email and you're like, I am here to save the day.
Yes. Let's make it happen.
Let's make it happen. And I'm
Yes.
so glad we met because everything fell in place, even under those circumstances. And
Yep.
I want to almost say you were clear to close. Not that this happens all the
Yeah.
time, but it like 5 days. Like I think we
Yeah.
were
That's a
like,
pretty.
yeah,
Yep.
Thursday, and on Tuesday you're like, hey, look, we can get this thing fixed.
Yes.
This is what I need. Da 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 da. And
Yep.
because of that, I was like, oh my gosh, you are a rock star.
Hey.
And yeah, so I'm excited. I wanted to bring you on here because there are a
Yeah.
lot of people out here who have a lot of questions about fix
Yep.
and flips. And I would love for you to share your presentation. You can kind of go through it. I'm so excited. So
Oh,
I will
beautiful.
let you take it from here
That was an
for sure.
amazing. Anytime I do this, can you just come with me and you can like say, hey, this is what we did. A soft spot for specifically Cleveland because I have rentals there too. So I get like smaller price points. Sometimes lenders like, I mean, we do have a minimum,
Mhm.
but like if the deal makes sense, why not? Like let's go, let's make it happen. And so I'm really glad that we met. There's going to be many more in our future together, and just if it makes sense, borrow makes sense, let's make it happen. So perfect.
Love
Um,
it.
let's today we're going to talk about hard money like 101. What is it? Do you mind me sharing? I'll share my screen and let me just do this real quick. Always a
Woo,
what?
there it is.
There it is. Do you see hard 101?
I see it.
Awesome. Okay. When I share in Zoom, I can't really see that much, so I want to make sure. So I want you to ask me any questions that you can, okay? And I know you have specific questions, but I want to like make sure I'll talk about hard money and then just let's have this as a conversation. Let's do it.
Yeah, I love that. That's great.
Okay, so let's bear with me for a moment. I'm just gonna share the next one. So, who am I? I'm Lesa Say with Raincity Capital. I've been doing this for over 20 years. I have my own fix and flips. I have my own rentals, short term, long term. So I'm just someone that is providing a loan. I'm also someone that has been in this space, actively in this space, and knows also as an investor, what she's talking about. I've done a lot of loans as well, so there's that. It's always funny because talking about me is different than talking about somebody else, but just know that I've been here, I've been around. I will sniff out a bad deal, tell you it's a bad deal. I don't want you to get into something that's not going to be profitable because if you don't win, I don't win. And it's truly about a relationship in this line. So definitely want to make sure that everyone is taken care of. So that's a little bit about me. What hard money is? Hard money is an asset-based lending. So anybody that's like, hey, I want to live in the house, absolutely not. We're done. We're out. That is my big rule. Like, it has to be for an investment purposes. And why people choose to go to hard money versus conventional, we'll kind of go over. But the big thing is we're fast, just like you mentioned. My average is, I tell people 7 business days because when I, do it faster, people are like, wow, that was really fast. But typically it's 7 business days is how I roll. I could do it much quicker, as you know, but I like to say, give me 7, put it on the purchase and sale of 7 days or 10 business days, and let's just make it happen. So it's an asset-based loan, meaning I look at the asset to make sure, does this asset make sense? Is it profitable? I do look at the borrower. I do look at someone's credit. I do need a soft pull because I want to make sure that their bills. Are they paying their mortgage? Are they paying their credit cards? Because if they're not paying them, they're not going to pay me, and I don't want you in my loan. So I want to make sure you can get out. And especially if someone that is saying, hey, I want to buy this and keep it as a rental. Well, if they have a 600 credit score, I'm going to say, how are you going to keep it as a rental? Like, what are you doing? So I care about your takeout. I want to make sure it works for you. So hard money, fast, easy, and it's all about the asset first, what I look at. Any questions? I'm going to talk more about that, but any questions on that so far? Do you have for
No,
me?
I'm sure you're gonna go over a little bit about what makes a good asset, what doesn't make a good
Yeah,
asset. Okay, yeah. So if you're gonna talk about
absolutely.
that stuff, yeah, I think that would be great. Yeah, keep
Oh,
going.
wonderful. Perfect. Okay. So then I kind of talked about it in the other slide, but why people use it, it's the next best thing to cash. In my opinion, it's better than cash because why would you put all your eggs in one basket when you can maybe scale up and do 2 or 3 houses for the same price that you had for a down payment. So you are competing, especially in a lot of markets still. Cash is a real thing. People are buying in cash. If you don't want to put all your eggs in one basket or you don't have all that liquidity for one house, you would use hard money because traditionally that house that you're buying has like siding or a roof or not windows, doesn't have an oven, like things that conventional lenders need to do a loan on. I don't care. I know you're going to gain the equity because you're going to fix it up. So the property itself, I don't care what it looks like because you're going to make it great and you're going to make money off of it. So that's another reason why people use us, because we don't have the red tape. We are not a bank. We look the project and we can close really, really fast. So that's why people use hard money. I have lots of different options. I always, corny as it sounds, I always say it's like a one-stop shop because if it's an investment property, I got a loan for you. The only thing I can't do is just straight land. I can help you when you're ready to go vertical, but just land acquisition, I can't. But I got everything else. I got standard fix and flip, cash collateral, manufacturer swaps, ground up construction, rent out, DSCR loans, cross collateral, and in some states will go to auction. I will go over all that. But those are also the states that I'm in as well. We are actively growing, but we care about where our growth is because we want to make sure we provide excellent service. So we are slowly getting to more states.
What do
Yeah.
you think is your most popular, product out of these, or most popular product that you have the most
Yeah.
of?
Um, Always the bridge. Like that's sweet. That's not bridge. Standard fix flip buy and hold bridge type loans with reno or without. That is our bread and butter. Where most people want to get into a property that they need a fast close, don't want to go conventional and fix it up and sell it, or fix it up and then go into. I say the next one would be, I do a lot of manufactured swap properties. So believe it or not,
Really?
a lot of those are very state-based.
Hmm.
Washington, Tennessee, and Texas, they do a lot of those. And then the third I would say is the DSCR. DSCR is ramping up. We will definitely discuss that. But that is, I have a couple of DSCR loans as well. Even if I can qualify for standard, I do DSCR. because it's so much easier.
Yeah,
Um,
yeah. For
yeah,
people
it's
who don't know what a bridge loan or a manufactured swap is,
yep.
can you like give us like a 30-second
Oh
overview of
yeah,
what those
and
are?
you know
Yeah.
what's even better? I got a first slide for it. So it's even better.
Hey.
There we go. So what is a fix and flip loan or a bridge loan? Basically, there's just one very small caveat between the two. A lot of times intertwine bridge and a fix and flip because they're pretty much the exact same terms. It's when you have a property that you want to fix it up, and you will then purchase it. I will help you with acquisition and I'll help with renovation, and your down payment is on both of them. Um, this is a formula. If you don't have anything else, screenshot this because this is literally the formula that almost every hard money lender will look at. Is if I'm buying it for 300 and 350 my reno, my total loan to cost, that's how much it's going to cost me, is 350. And my ARV, what that means, that's an after reno value. I want to know what is this going to be worth when you're done with it, and I'm going to loan off of that. Um, if someone is experienced, they've done more than three deals, they have either 3 rentals or 2 flips and 1 rental, a total of 3 units. Are considered experienced and they can get 10% down. If they're newer, or let's say it's rural zoning or it's creative, cash collaterals or other items, then their best they'll get is 15% down. So that's why I put 2 different options here. Now 10% down, so 350 minus 10% down is your loan will be 315. You take the 315 and you divide it by your ARV value, and that's your LTV, loan to value, 63%. The max I can do, depending on what state, it's anywhere between 70 to 75. So this deal would be screaming. I'd be like, yeah, let's go. This is a great deal. So this formula is if you're new and you're a new investor, to get this down, because everyone's going to ask these very questions: purchase price, reno, ARV, after reno value, and then they're going to take the down and then they're going to divide that by your ARV, and then they're going to get the LTV. And the LTV is what I can determine if it's a good deal or not a good deal. Let's say, hypothetically, I'm at like 80% or 90%, or even let's say 95 after the down payment. I'll be like, hey, why are you doing this? This deal doesn't make sense. You're not going to make any money. Well, in Washington, right now, dadu plays and minimizing and all that is big. So if their end play is, hey, I'm going to buy this lot, but it's on a huge 10,000 square foot lot, I'm going to build a dadu, then I would understand the process and what they're going to do to the property. And no, they're not going to probably make money on the first one, but they're going to be able to build a dadu and a 3rd unit, and that's where they're going to make their money. So I look at the deal specifically. So in those incidents and like that, I would say, okay, let's do the deal. And okay, that works. But if it's just a flip, I'll be like, hey, you're not making any money here. Are we keeping it as a rental or what are we doing? And that's where I'll have the conversation. Now, if it's a bridge loan, that's when someone has either A, owned it free and clear, and they just found another awesome deal, and they're like, crap, all my money right here, it's free and clear, I need to access this, and a HELOC is going to take 5 days, and I want to go buy that bad boy. I could take and I could get a loan on that, and I could give you cash out. Or I can do what's called a cash collateral, and I use that equity as their down payment, and I could go help them buy it. So the bridge is really a creative way to access someone's liquidity inside their free and clear property. Or, hey, I want to buy this property. I don't want to put reno in. That's it's a bridge from there because there's no reno. It's just it's a one loan type of package. Did I answer that question for you? Do you have any questions on that one?
Yeah, yeah. Well, you
Yeah.
mentioned a little bit earlier about FICO score too,
Yeah.
and we're talking about down payments.
Yep.
What what do you have a minimum FICO score, or does
Right.
the FICO score just, also determine 10%, 15% down as well?
Perfect question. So when it comes to your credit, it's not a deciding, but it is a determining factor of like being able which program you can be into. So if you have above 680, you can qualify for the experienced borrower program. My minimum is 660, but I will say we are human. This is a business where contractors love to get points, so they'll put stuff on cards, and then their debt to service ratio goes, and then we pay them
Yeah.
back with the draw process, which I'll go over, and then it skyrockets back up again. So when I say that, when someone I've been working with for years has 100 and then they dip to like, let's say 679, that's right outside that window of being creative, and they've paid us on time all the time and they do great work, I'm going to give them an exception. Of course, that's going to happen. So there's flexibility and there, but standard 680 for the experience, 660 is like the line. Now, have I done a new borrower for like 59 or 650? Yes, as long as that's because they didn't have credit. It's not that they weren't paying. So there's a difference there.
Right.
So, yeah.
All right. One last question, because you also
Yeah.
mentioned down payment, right? 10%,
Yeah.
15%. Can someone on a fix and flip loan, can someone use hard money right now? Can
Yep.
someone use like a private money lender to
Like a gap.
solidify their gap for their down payment to get them into this new loan?
Got it. Great question. So we always require a borrower to have skin in the game. They can use a gap. They could do seller carryback, but they have to have at least 5% of total loan to cost in the deal. We don't want someone to just be like, I can't do this. I mean, if they have no skin in the game, we don't want to have skin in the game. So they at least need to have
Fair
5%.
enough.
Yep.
Yeah.
Yeah,
Do
5%.
you do you require them to have any reserves as well, like in the bank,
Yes.
cash sitting in? Okay.
Yeah, there's a difference between being creative and finding a good solution to not use your own money, not be able to, you don't have money yourself. Um,
Right.
I'm just like, I'm not going to penalize you because you're able to do a seller carryback, and you have all this liquidity in the bank. I know that your risk is low because you have assets you just don't use versus I only got five and that's literally my last dollar. I won't I won't put them in my loan. Yeah.
Are you flexible, or do you have a like a certain threshold, like you need three months of reserves, 12
3 months
months of
reserve.
reserves?
Yeah. 3 to 6 months. I like to see 6 months. I kind of pride myself. I have like the lowest default rate in Raincity. So I kind of keep that. I just want to make sure you can do the deal. And honestly, got to make someone feel really good. I've been told many times, like, I know you're not going to let me get a crappy deal. And it's just a nice sense of security for them. I have someone that could pay cash on all their stuff, but they're like, I would rather have a lender look. Because I also, we review title, make sure we're the first lien in position. It's great to have, a company look at this deal and say, yeah, that's good. It's great versus cash. You can have a title report, but if you don't know how to read them, things
And
can
I think
happen.
and I think it solidifies that you all are also in the game, right? In the game in the sense of you have rentals, you're doing this as well. So you're
Yeah,
kind of like that second size outside of just even being a lender saying, hey, look,
right.
this is a good deal because I would do the deal myself.
Right, right. And like I'll give an example. So one of the units for who we were working with, they were promoting it as 3 units, but when I got it, I was like, wait, this is zoned for a duplex, and there's no way that city is going to allow it to be a triplex because we've already like looked into that. They were
Mhm.
going to go and purchase it thinking that it's a triplex and that they can then just re-permit it, which doesn't happen, which will affect his takeout for the DDR because we can't use that third unit. And so there's another set of eyes on it, and someone that's lending you the money will make sure it's a good deal. Yeah. Versus like
Awesome.
someone else. So
Yeah.
the contractor might be like, yeah, great. Or, you know, the agent be like, yeah, this is great. Well, as a lending money standpoint, not so much. So yeah, happy to help. So what the next thing I wanted to talk about is draws. This is a big one. So noticed in the other screen, I said the example was 350,000 renovation. I will give you 100% of your renovation. So the total down payment is total loan to cost. But if you do the work, I will reimburse you. That's the key thing there. I'm not going to just give you that full 50,000 and say, hey, good luck. I hope you do it and you don't go to like the casino or something. I will make sure it's based on completed work, which is also a good thing because you don't pay interest on the renovation if you don't use it. And so it helps break down the costs instead of me just giving you the money up front and say, okay, now you got to pay front. You use it, I reimburse you, and then you pay for it. Kind of how the draw works on there. And once again, my loans do not have penalties. My CR 30-year, which I'll talk about, does, but all my other ones don't. We want you in and out as quickly as possible, and we're not going to penalize you because you did it quickly. We're just going to help you get the next one.
And how do, for someone who's never done a fix and flip, talking about draws, like, what is, let's like to the basics of a draw. Like, how do they even like, how do you even get the draw,
how do they
even
request it?
Estimate, an estimate up for their draws of what they need.
And one of the biggest things I can't stress, if anyone walks away from this and they like, what is hard money? They understand what it is for its investment purposes. And two other things. Don't get in a loan that's a hard money loan less than 12 months. Everyone believes that they're going to get in and out in 3 months and it's going to be fine and dandy. So when they do a 6-month loan, plenty of time. Well, guess what? Life happens. Maybe there's a shortage on wood, or your contractor screwed up. Someone I know really well, they're very seasoned. Their contractor painted the house absolute color, then they had to repaint it. Things happen. They always do. And in this market, you might have a buyer, but then they lost their financing because of interest rates or what the case may be. So now you got to go back on the market. So you want to get one that's no pre-approval, no prepayment penalty. Prepayment penalty. And you want one that's at least 12 months. 12 months is a solid, because if something was to happen and now you need to keep it as a rental because let's say values go lower and it doesn't make sense to sell, you want to be able to get it rented and then have a takeout time. So stress that. Can't say that enough. And then the second is the draws. You want to ask them, hey, is this in-house or are you going to sell my loan? And then someone that's not even associated with caring about this loan is going to handle my draws. You may think that that's not a big deal, but it is. So we have everything in-house. Our servicing is in-house, our draws are in-house, and how we do your loan is all in-house. So what that means is if there's a problem, because it matters when there's a problem, right? How they handle it. I own the loan. We don't sellers, we own the loan. So we're going to care that you finish it and those draws work, versus if someone said, now it's a company that takes care of it and then they have to go back and forth and it could be a problem. So those things, no prepayment penalty, 12 months, and is your draws in-house or do you sell them? Those are big for you as an investor to keep the relationship and the fluency of the project going quickly. Those would be my advice. How draws work is let's say in your budget, you have roof. Roof is 10,000. That's hypothetical. You would then do the roof. We would call an inspector to come out. It's not a city inspector, it's our inspector. They take pictures and they say, yep, 100% completed. We then give you a wire for $10,000. It is on whatever amount you have, the amount you're getting. It is on completed work. We don't ask for receipts. We see that the work is completed. Another reason to use hard money versus conventional is most of the people that are doing are contractors themselves. They're saving money because they can do the work. So they're just doing materials. Versus conventional, they don't want you touching it. They want you to outsource it. You have to pay somebody else to do what you are great at doing. So they don't like that. Our draws are, 72-hour turnaround time. So if you order on a Monday morning, we come out there on Tuesday. We get the report back on Wednesday. If it's before wire cutoff, you'll get your money. If not, it'll be the next day. So it's very quick. We are a very efficient fine oil machine.
That's really nice because if someone is trying to stick to a schedule, if they do want to
Mhm.
get out of it in 3 months,
Yeah.
right, or 6 months, and they
Yes.
know like, hey, I have to stick to this timeline, at least the
Yes.
draws are not going to be the thing that's holding them up.
Right.
Something else. Yeah.
Yes. You always want to ask, how long is your typical draw time? Is it in-house? Because you could love the person that's helping you do the loan, but if you ain't getting your money, that's time. So
Uh,
you need to get it back.
All right, one more thing about draws. So when
Yes.
people are putting together their estimates, right?
Mhm.
And I am not a contractor construction. I go
Right.
in, I look at a bathroom. I'm like, yeah, $1,500 maybe.
Yeah.
How do you determine what qualifies as a good estimate, or who's allowed to provide the estimates? Do they have to be like a specific certification or some type of
Right.
qualification that they need?
Any investor that's new, I always tell them to start going down Home Depot and looking how much stuff things cost. So that way, when you get a bid from a contractor and they're sniffing out your new, there's not added cost to it that got added to it. This is exciting. You're learning how to, you need to know what the cost is.
Mm,
So most people, I always say, hey, if you don't know it, don't know anything, start going up and down. How much is sheetrock? How much is wood? How much is doors? Like, get to know your material cost, and get a couple contractors to give you bids. The contractors they'll give you a bid. That's another reason, someone to have a look at it. If I'm looking at this and you say, oh, 20,000 for laminate flooring, and it's like a 2,000 foot house, I'm gonna be like, hey, what kind of quality we got here? Like, what are we doing? Like, this is a lot of money. Like, can I eat off this like flooring? Like, what's going on here? And so I do look at it. I make sure there's like not anything gross, because I look at it because I'm also determining after reno value. So
yep.
quality matter, right? Or if you're putting brand new hardwood and you're telling me it's only going to be 3,000, I'm like, wait, where are you getting
Mm.
that hardwood? I want to buy some. So knowing the cost of material, your contractor look at it. Always put a contingency in your budget. Always. So contingency, for those that may not know, is it's like your oh no bucket. And it's
Hmm.
like, I'm putting 10% of my total cost if there's any overages that I need to pull from and get it. So that way, if you didn't predict a price correctly, you can then dabble into that and grab it.
And, and you said even if they have like this contingency budget set aside, if
Yeah,
they don't use it, then they don't get, they don't pay interest on it, right? That's what you
they don't pay for
that's
it.
awesome. Awesome.
Correct. Yes.
Awesome.
Yes. Yeah. Yep. And they know. So draws are really important, and I'm so glad you asked it, because everyone thinks, oh, I just need to figure out the best rate, the best points, the best this, and really the quality of the service and what you're getting for draws really does make or break your project. So it's really important. So it's great that you're asking these questions. That's really good. So everyone
All right.
asks
Well,
about themselves.
one last question then, because
Yeah.
if I'm a new fixer flipper, right, and I know nothing
Yep.
about, construction, is there an inspection process that allow me to make sure that I am fixing the right stuff, or I missed something, or maybe I don't need to fix that thing over there, but this is more important? Because sometimes as I been through construction, right, all of a sudden you take something off and now there's mold and now you got to replace this whole thing, right? So
Yes.
is there an inspection process before the loan or before the draws are given to allow, I guess, a sense of security that,
Yeah.
hey, I'm going into this project, with the right headspace?
Yes. Great question. A couple answers to those questions. One is, flexibility in real estate and investing is the most important mindset you could possibly have. Nothing set in stone. It's one of the biggest things why you said, oh, well, what if I open up the wall and then there's mold? When someone tells me they don't want to put renovation in their budget, that is the prime example I give. What if the unforeseen happens and you have, so your budget is 50,000 and you have 100,000? You think that's plenty of money to pay my bills, that's plenty of money to go over. But what happens if it's not? You open it up and there's a leak and there's all this. At least you have that 50K that you get reimbursed, that you can then spend that 100K on something else. Things do happen, unfortunately. I would say we inspect the house. We do a BPO of what the after reno value is, but we're not going to go inspect the house. That's the buyer's due diligence of getting it inspected, having an inspector come out, having their agent look at it, and all that. Like your team around you, you need a good lender, a good agent, escrow, insurance. Like you can't do it all. You need to have good people around you. So we don't inspect it before you buy it. That is your due diligence period. And then what you do is make sure your budget is good. You're not skimping on your budget. You have a contingency. And the more you do it, the better you will become at it as well.
And the RV is determined by the appraiser, right? Is that what you
The
have
BPO
go
and
out?
us, we
Yeah.
do a lot of internal BPOs. So what
Okay.
determines is what are you doing to it? Let's say you have a really nasty house with siding bad, windows bad, roof bad, like everything. But then you give me an ARV and you're only touching the outside. You're not going to have the best ARV because you're not touching the inside. So your
Mhm.
budget really helps determine what that after value is going to be.
Got it. And what does BPO stand for people?
Broker opinion. Yeah, your
Yeah.
broker's opinion. We do two. We do an external, but we always do an internal. And statistically, our internals are way more accurate because we will then go back. And when they sold, we make sure we're realigned. It's actually a auditing process for us. We're pretty dang spot on to BPO's values. So we always do a third party just to make sure, but we're pretty solid on that. Yeah, awesome. So that's about draws. So I will touch on this. I won't go too depth because this is kind of next high level, but I wanted to explain this. If someone comes to you and is like, hey, I want to fix it up and I want to then hold and I want to DSCR them, which we'll talk about. First thing you do, you want to get into a BRRRR type of loan. And this is the way to get your money back. So the other examples were fix and flips, right? Where you put the down payment, your payment, then lower your loan amount. Well, when you go to fix it up and refi it, you really don't want that low loan amount because then you're going to be becoming a cash out versus a rate term, which then your rate will actually be higher. So this is using your down payment as collateral. Meaning for this example, we're buying a 150 property, putting in 50,000 renovation. If we would have done 20% down, that would be 40,000. That means your loan would be 160 when you go to take out. However, you want it to be 200. So you will give us the down payment, non-interest bearing account. We hold it, that's your cash. You are paying on $200,000 because that's your loan, because we're just using it as collateral. When you go to refi, your balance is now 200,000. So then you get a loan for 200,000 versus the 160. You get a rate term versus cash out. And then when you pay us off, we give you your money back. So it's a way to not have all your money sitting in the deal when you're going to hold it. This is a great program if you know you're going to hold it. You do not do this program if you think you're going to hold it, or you're not sure, or you're going to flip it and then it turns into it. Because I have to know in the beginning that this is how we're setting it up when we close on the purchase of it. So it's great. There's no seasoning. You did rate term versus cash out. You're holding your cash back and you get it back. So when the time comes and we have someone or someone's interested in it, I'll dive into this because it's a great program if you know you're going to hold a property.
Nice.
Yes. Yes. Okay. So our 30 year, we are a DSCR lender. So all our bridges were direct to our DSCR loans were direct. Our bridges and all the other type of loans, it's our funds, our liquidity, gives us more flexibility. We're not selling it, so you don't have to fit inside this box. So it's great flexibility. DSCR, we do sell them. These are 30-year notes that when your project is complete and you have a renter. Now, can I do it before you have a renter? Yeah, I could do it, but then I'm at 90% of market value, which that's leaving 10% of your money on the table. So you want to fix it up, get a lease, and then I could do this loan. If I have the bridge, 3 months, and then I could do the 90 days if I do the loan. If I didn't do the loan and I put you in DCR, then I have to wait 6 months from the day you purchased it to actually get the ARV value. Could do the LTC, meaning what did you fix it, and get that higher, but you might as well just wait till the other value. Why someone does this instead of a conventional? I'll give an example of why I did it. I absolutely qualify for conventional lending. You only get 10 per individual. I want to keep it in my LLC, and it doesn't go on my credit report. So it doesn't also doesn't go off my debt service. Also, it goes off of the property, not me. So I have multiple properties. So if I go conventionally, as you're aware, I got to make sure I can fit with all of them. I just look at this one property. Does this property pay for itself? Does the rent pay for the taxes, insurance, and mortgage payment? That is how it's qualified. The better credit you have, the better interest rate you get. The higher the LTV, it starts lowering your interest rate, but not that significant. A lot of times I'm actually beating or very comparable to conventional lending quotes. Also, you don't give your firstborn child to me. I don't do tax returns. I don't do W-2s. I don't need any of that. I don't need that. I just need to see, is it leased? Is the rent been deposited? And what is the value? So it really just goes on with the same concept. I look at the asset first, borrower second. It's super easy. For me, I'm like, I don't want to give all that stuff. Why do I need to give all that stuff? Just do this and make it be done with it.
With the DSCRs, what is your typical down payment range, and is it factored by a FICO score? I think you mentioned that a little bit, but the down payment, what are they going to be looking at when they come into the DSCR?
You can purchase on DSCR. However, the best use of a DSCR loans is when you buy a property, fix it up, and get it rented, because I'm going to go off of what rented and what the current value is. The likelihood of someone selling nothing wrong with the property, it would pass in a traditional appraisal, and if that market value is like a unicorn, like that, people won't get rid of those properties. There's typically one of those two off, meaning the property needs work, or they haven't raised the rent on these people in years because they love them and they're just done being a landlord. So one of those two need to go up. So in my experience, it's very rare that you buy one with no issues, nothing that needs to be fixed, and that they're actually getting market value rent. I just have to qualify for what it is. So let me give you an example. Let's say there was deferred maintenance. A house value would normally be, let's say, $300,000, but they need new windows. Like, it has to pass a conventional type of appraisal on this product. Let's say like there's a couple windows out, or there's some siding issues or whatever. So it's really now valued at like $225 with some deferred maintenance. Maybe it'll pass the appraisal, but I have to go off the value of the $225 versus the $300. Or let's say they've been there for 10 years and they're only paying rent for 2,000, but market value is 3. I have to qualify the loan off of the 2,000 versus the 3. So it makes more sense to buy it in a bridge, fix it up, get a renter in there that's market value, then go to a DSCR. Now, let's say you found that property. It is 80% max LTV. So you're putting 20% down. So why would you put 20% down when you can get the equity? Like, you know what I mean? Like, you could go lower and do the equity and then have less down. Because my loan for bridge, 15, 10, I do have as low as 5% down after they've done more than 8. They can do 5% down. So why not do it in a bridge and then go into a DSCR loan? So I always look at each loan, each project individually. I say, what are we going to do with it? What's the end result? And put you in the loan, because I have all these different kind of loans that fits that project. It's best.
Got it. So if someone did the bridge loan, they fixed up the property, they're going
Yep.
to rent it out, but maybe they're not renting it out right now and they want to move it into the DSCR. Do you take if like an appraiser comes out and says, "Hey, this should appraise at this amount, $2,500 a month rental." Do you take
Yep.
that appraiser, or does it have to be a hard lease connected
Right.
to the DSCR or to the
Great
property?
question. So let's say they don't want to wait till they have it leased, and let's say 200 is what they're going to get. I only can take 90% of market value
Okay.
versus if you have it rented at 2,500, or let's say you have it a little bit. And as we know with appraisers, if it's rented for that, normally you can find comps for that price at, like, let's say that's 26. So I would strongly encourage anybody to not leave money on the table, get it rented, and then do the DSCR.
For the DSCRs, do you also require uh, money in the bank as far as reserves? That's what I meant to say.
Yeah.
Reserve. Do you require
Yeah,
reserves?
reserves.
How long?
It's a good rule of thumb to always have 3 to 6 months in the bank. And for yourself, and stuff
Sure.
happens,
Yeah.
renters don't pay. Like, it costs money to be in this business. And if people are like, hey, I don't know how to get started because I don't have any, pair up, bring value to somebody else. If you don't have the liquidity, but you know how to slay the hammer and fix things, say, hey, I'll do this, but let's you work together and make it. Like, people that are investors are very creative and can always, um, you know, they love to work together. Everyone wants to teach somebody
Yeah.
how to bring up in this business. It's one of my favorite things about this business is people help each other out all the time. So just pair up with someone. But I gotta have money. Gotta have money.
All right,
Gotta
keep
have it.
going. Yeah.
Yes. Okay, so that's our DSCR. So you fix it up. I can help you with the takeout as well. The benefit of this is I don't need W-2s, don't need tax returns. I keep it in the LLC. It goes off the rent. Now, let's say on the flip side, you have a property that you are condominiumizing it, or you're adding a dadu that maybe the rent doesn't pay for that unit specifically. That's when you would want to go to conventional, that if the rent was not paying self-sustaining. Of course, if it's not self-sustaining, you want to ask, is this a good project? So it's all
Mhm.
the reason behind it on it. But DSCRs are a great type of loan to use. So just a recap of kind of like rate terms on it is fix and flip, buy and holds 12 months, origination. I can go up to 5%, close really quickly. 30 years. Originations are around 2, but that's where it's like, if you're buying down the rate or you're, doing the prepayment penalty, like it all kind of, but it's around 2. My max is 4 units for 30 years. Flips, no, I'm not maxed out. New construction. I haven't talked about new construction. New construction is one that you have to have experience. My flips, we will do newbies. We all got to start somewhere. Ground up construction, you have to have one on your belt on title. Can't be for somebody else. I need to make sure you've managed a fix and flip, so I can do those. So really, that's, I would love to answer any question that maybe I didn't hit on the ones that you have, but
Yeah.
in a nutshell, that is, hard money on it. So what kind of questions you got for me?
No, that was great. I think people who are both new and veterans in the game, maybe like for them to avoid any pitfalls, right? What are some
Yeah,
things that you see when deals come through like across the table? You're like, okay, I could see like red flags right away. Are there anything that because you mentioned earlier, you said, hey, look, the duplex or the
yeah,
triplex is really a duplex, right? Like
yeah,
I guess the question is going to be, how do people avoid common mistakes and what are those common mistakes that they can avoid when getting into
yeah.
their fix and flip?
Uh, Fabulous question. What I see when people get into like a pickle or not is they don't do their own due diligence and they rely on the expert to do it. Meaning, for example, that duplex, the buyer needs to then call the city and be like, hey, this says it's a duplex, there's a triplex here. Like, can I convert this and can I get it permitted because I want it to be a triplex instead of just going off of what the listing says. Someone that's really hungry for a deal might overlook the red flags. So no deal is worth not making a profit over. So like in the beginning, sometimes people are just so excited about one, they think it's a good deal and they're looking at the red flags. That's why you need a team, especially in the beginning. It's always good. I mean, I have very seasoned veterans that will call me to pick my brain and say, hey, I want you to look at this property. I'm not quite sure about it. ARV, your after rental value, is crucial because that determines on what you can buy it at. Because if you're buying a deal that's only worth 600 and you're buying it for 550 and you're putting 75 in, you're in the hole for 25. So like you need to know what that value is and you need to know the cost of things. So really education, educating yourself, and then just doing it too. So I know that's on the flip side. There's people that are they want to know everything
Mm.
about a project before they'll actually do it. This is a job where you learn on the job. This is one that you can't read a book and go to a seminar and have all the answers and you're not going to have any problems. Not going to happen. Like every house is different. So I think just being able to say, I don't know what I don't know, but I'm willing to find out is huge. Like,
Yeah, I
you know
think
what I
that's
mean?
I think that's great advice. There are a couple borrowers that I'm talking to even now, and they want to gather all the information they can before they make a move, which is good as part of their due
Yes.
diligence. But sometimes you just got to dive in
Yeah.
and build the airplane on the way down, and that's the best way you're gonna learn sometimes. But
Right. Right. I had
yeah,
someone say to me, why are you buying a different state? I'm like, the numbers work. It makes sense. I will figure it out. So like,
yeah.
they're like, we can never do that. I'm like, I got a couple good properties by doing that. So, you gotta sometimes believe in yourself and know that you just gotta figure it out. Just gotta figure it out.
All right, Lisa, listen, I appreciate you taking your time
Yes.
out. I love to do deals with you, so I'm so
Yep.
excited. So if people are looking for the next fix and flip,
Yep.
we'll definitely send them your way. Thank you.
I love it. Thank you so much. I appreciate you.